Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We have sorted that audio with Pankaj Pandey. Pankaj, since we are discussing pharma, let's discuss your pick as well. Ipca is a stock that you like, which is interesting.
Yes, Anuj. So on Ipca, we have a target price of 845. So if you look at last 4-5 years, the company did not do much. So the sales growth was pretty muted at about 3% and also because of the fact that they had 3 import alerts on the plants, which was impacting their capacity utilization, and also there was a good chunk of business coming from the anti-malarial business, which was volatile. So as a result of that, the overall performance in the last 4-5 years were quite muted. But what has changed is that domestically we are seeing a decent growth of about 14% compared to a historical growth of 10%. Now compared to anti-malarial segment, the growth in pain management has been far more higher, and this business now contributes about 14% and has been growing at a pretty healthy clip. So we expect domestic formulation, which contributes about 43% of the business, to grow at about 14%. On the export side, we expect the growth to inch up from about 6%, which was there a few years back, to about 15%, largely because of the institutional tender business. So both domestic and export formulation should do well, and then you have API business, which should be chipping in with about 12% kind of a growth. Now all this growth will lead to a good margin expansion. So we are expecting about 200 bips kind of a margin expansion to about 16% in FY19, which is what also the management has guided. And we expect a further improvement in EBITDA margins by 300 bips to about 19%. So that should lead to a good delta in EBITDA of about 33% and about 49% in profits. And ROCE also should improve to about 17-18% in the next 2 years. So at 20 times FY20, we get a target price of 845, and we believe that the stock should do well going forward.
Okay, by the way, just reading some comments from Dilip Shangvi, and the reason I want to mention that is keep an eye also on Sun Pharma Advanced Research, SPARC, because he's talking about 2 specialty products, Celpros and Ellipsia, filed from Halol. These 2 drugs actually belong to SPARC. So, that I think is the reason that I want to watch out for that stock as well. And those are comments coming in from Dilip Shangvi. In fact, it's in the press release that Sun Pharma has just filed. So that's the reason. And of course, normally you see that kind of move, post move in Sun Pharma. The SPARC stock also follows. Yeah. So that stock right now up about 7.5%.
Oh, absolutely. It's been quite a day for both the Sun Pharma twins, or the Sun Pharma and Sun Pharma Advanced Research, both of those stocks. Pankaj, I'm looking at your next pick, which is Majesco. This is an interesting one. I mean, this is one mid-cap IT stock that hasn't done as well as some of its peers. I think you have a 710 target on it. What makes you so optimistic on Majesco?
So if you look at last 2-3 years or past 3 years, the company has been growing at 16-17% in terms of top line. We would expect largely the top line run rate to sort of be maintained. So dollar revenue growth could be about 14% and the balance coming from currency tailwinds. But what has changed is that the company has started making profits. So 2 years back, they were making losses of about 7.5 crores. Now they are making marginal profits. So they did about 2.8 crore kind of a profit in FY18, and in Q1 their margin profile improved significantly to about 8.2% and mind you, they were making margins of about 2.8% a year before. Now because of that, we would see a good bump up in profitability, and this is also coming from the fact that now what we see in their business is that the business segment profile is sort of changing. So they're getting 1/3 or 36% of their revenues from iCloud, and they've got a good deal pipeline, and 80% of this deal pipeline is coming from iCloud. So what we expect is that the margin profile will keep getting better to about 10.5% in the next 2 years, and so that should help them deliver about 60 crore kind of a profit in FY19 and about 77 crore kind of profit in FY20. And if you look at from a valuation perspective, see the industry leader, which is Guidewire, is trading at a substantial multiple. So even if we are giving at 4 times EV by sales basis, which is again a 50% discount to Guidewire, we are getting a value of about 710, given the fact that the Indian entity holds 70% in the US business. So even after that, we are getting a significant upside, and with the kind of delta what we are seeing on the margins, and mind you, they spend a good amount of their money on R&D. So about 14% of their revenues spent on R&D. So since it's a product business, you need to spend that kind of R&D, but those benefits are really not visible at this point in time in terms of the bottom line what we see. So we expect that going forward with higher traction, the margin profile will keep getting better, and this company will start getting better traction on the profits and even in top line as well.
Okay, turning out to be a big pharma day, by the way. A lot of pharma stocks moving to high point. I think Biocon has been the other stock which has been making a move. Lupin is up about 3%. Sun Pharma, of course, is the biggest gainer, but Divi's Labs, so a lot of these stocks doing well. Pankaj, final stock, Transport Corp?
So on Transport Corporation, we have a target price of 400. We believe that this will be the biggest beneficiary of GST implementation, higher axle truckload, and higher regulatory scrutiny which is going to happen subsequently because of e-way bill and all that. And now what we like is that, so if you look at their basic business, which is your freight business, that used to contribute in excess of 50% odd. Typically this is a low ROS business, so about 12-13% odd. And now this this as a segment was not growing until FY17, where the growth was about in single digits, about 3 odd%. This segment has started doing well from FY17 onwards, and we are seeing growth rate of about 13-14 odd%. But what we really like about this company is the supply chain business, which now contributes 40% of the top line. Last year it grew about 24 odd%. This particular quarter about 19 odd%, and this business has a good ROC of about 22-23 odd%. And besides that, they have a shipping business also, which is also a decent business with 11% contribution to overall top line and decent ROCs. But what we expect is that the company has been doing is looking to do a capex of 250 odd crores, which will be largely in these two businesses, which are high ROC in nature, and that should sort of improve the overall ROS profile of this company going forward. And it is available at about 11 times. So which is why I believe that with improved ROCs and better or higher share of supply chain business, which is a sticky business, I think the company will command better valuation, and which is why we believe that 400 target price for this stock should not be a big task.